Hello, everyone. We will talk today about what happened in 2021 and what is the outlook and how we see different asset classes pan out in 2022. So, our 2021 India investing insights, as we called it, was premised on the fact that central banks have cut interest rate, there's too much liquidity, growth is recovering, and global investors will search for yield, growth, and returns. And it will have a significant impact on asset classes globally as well as Indian asset classes. And we know now that capital did move in a significant manner chasing growth and returns. If you look at global inflows into equities, public equities, it was estimated at about USD $1 trillion. That's more than what foreign global investors have invested in equities over the last 19 years. That's a significant amount of money that went into global public equities. The private asset market also, private equity, real estate, infrastructure had another significantly large year of capital raise of almost $1 trillion. And the major standout was the global venture capital industry. And, for a niche segment, niche industry, it reported almost $650 billion of global venture investments. That's significant. In India also, we saw that venture capital investments was the talk of the town. The maturing ecosystem that India has had, more than 1 billion Aadhaar cards, billion mobile phone numbers, new bank accounts in Jandan, digital payments, the availability of tech talent. And combine that with the positive flow impact which came from China. As China cracked down on its tech sectors and education sector and consumer sectors, global private equity and venture capital investors looked for the next big market, which is India. And it led to a significantly large inflows into India. Almost $35 billion of venture capital investments was done in India in 2021. As you would now know, unicorns, like India now has or ended the year 2021 with 83 unicorns. 44 of them, unicorns means entities which have $1 billion valuation, achieved that status in 2021. That shows the amount of money and interest that came about. Despite what appears like a bubble in that VC startup space, we believe that these large flows from private equity venture capital, when it grows into developing new Indian businesses, new Indian brands, new Indian markets, new Indian platforms, that bodes well for the long term. In the Indian public equity markets also, it was a significantly strong year, especially in the mid and small cap space. The IPO boom continued and expected to continue in the next year also. And the increase in indices with a strong return for this year was despite foreigners being net sellers in the last 3 years. And if you see since 2015, in the 5 of those 7 years since 2015, Indian domestic mutual funds have bought more than foreign investors. And that's like driven by the retail Indian savings into SIPs, inflows into direct lump sum inflows in equities. And this is just a start, right? We know that India is a young country. As incomes increase, this secular trend of people who are under invested in equities, and as they keep on increasing the allocation to equities, domestic Indian retail investor through direct equities or through mutual funds will be a very significant driver of markets. And that also has led to the proverbial question that comes about with India, which is that Indian markets are expensive. And historically, we've seen that Indian markets, driven by strong earnings and relatively strong GDP growth, tends to have a slightly higher valuation. We would agree that given the current relative valuation, like India has done significantly better than other emerging markets, including China. Right? So we do believe there's a short-term case for, say, a global investor taking off some money and from India and allocating it to the beaten down emerging markets like China or like South Africa or like a lot of other EMs. That can take away some sheen from the market. The Indian IPO boom, which is also set to continue in 2022, which will again increase supply and take away some demand. And India may also see some outflows as global central bankers remove the excess liquidity and tighten interest rates. You should see some volatility, and you will see some negative volatility in the equity markets. But we believe that even though these things happen, if you are a 3, 5, 10-year investor and looking out over the long term, any opportunity given by the Indian equity markets, if it cracks down, we believe it's a opportunity to, if you're a global investor, to allocate to or over allocate to India, and if you're a retail Indian investor, to keep increasing the allocation to equities. And the reason we say that is, as we said last in our last podcast, that we believe that India is at the cusp of a sustained economic revival, and we gave 5 points to that. One was that the corporate balance sheets and the uh, bank balance sheets, corporate balance sheets are getting better. They have repaid debt, debt to equity has fallen, their profit margins are increasing, growth is getting better, market share gains from informal to formal sector. And banks also, they've seen a fall in NPAs. Their balance sheets is much better. They've raised capital. The ability to take risks is increasing. That's one tailwind. The second tailwind comes from the export sector. Finally, global growth is recovering, and Indian exports are picking up, and that drives its own demand and drives its own capex. And that's always a very good sign that when domestic demand is weak, if there's a global demand, then companies can export and increase their revenue and profitability. The third, which is the most important, is a residential real estate cycle. We are finally seeing it turning around. Low interest rates, government support has ensured that affordability has got better. And when residential real estate, house building or house buying increases, it has a multiplier impact in the economy, and that's another very large tailwind. The fourth is the government itself is spending a lot more on capex. They've increased the fiscal deficit. They're willing to spend more on building capex. The PLI scheme that they're coming about with in manufacturing should front load some bit of capex. So that's another tailwind. And the last, as I said, is the availability of capital. Global money is looking for returns, and India is the large market which can absorb money across asset classes: equity, private equity, venture capital, real estate, infrastructure, and of course, as we get into the bond index, even in fixed income. So these are all fairly significant tailwinds. With a good bit of luck and a good sane policy making, we should be able to take benefit of some of these tailwinds. And if the global world is indeed in the 2003, 2007 growth phase, we believe that despite what you see about valuations being expensive, we could actually see that Indian corporates are in a multi-year earnings growth cycle. The other Indian asset class, which is more from an institutional perspective, for an institutional investor, the other asset class which is getting us excited, as I said, is real estate. As I said, improving affordability, lower interest rates, government support, inventory falling, demand coming back. We believe there are opportunities for institutional real estate play in two aspects. One is there are still stressed developers who have debt on their balance sheets, have not cleared it, and there is an opportunity to take out the debt and and do a real estate credit play, drive with the background of this cycle, or just getting into real estate project equity kind of transaction. So from an institutional investor perspective, that we believe that those are very good opportunities, and as more capital comes in, this will get even more broad based. From a retail investor or individual HNI investor perspective, it's really the individual decision. We've never been very big fans of owning too much money and too much real estate. Equities tend to be far more liquid and gives you almost similar or more returns over a long period of time, but that it becomes an individual decision. In fixed income, we see divergence as our key theme, and the Debt Market Observer report that is there on the Quantum AMC website talks about these divergences in detail, and I'll briefly summarize it. The one divergence that we see is the US Fed. The US Fed inflation in the US is way higher than target, and the US Fed is likely to increase interest rates. Everybody knows that. But how much will they increase interest rates? When will they stop buying bonds? When will they reduce their balance sheet? And what kind of impact does that have on global flows and thus on the global dollar and the US interest rates? So that that divergence in terms of what the Fed is likely to do and what is expected by the investors, both in US and globally, will have a big impact on fixed income returns. The second divergence we see is that exit policies by all central banks. Like when COVID happened, all central banks globally did similar things. They cut interest rates, they added liquidity, they gave moratorium to support the banking system. Right? This is almost everybody did this. But now, as inflation is evolving in a different manner, as different countries recover in a different manner from a growth perspective, many central bankers have already tightened interest rates. They have already reduced liquidity. Some developed countries have started doing it, and the US Fed is likely to do that in 2022. So entry was synchronous, exit is going to be very, very different, and that will always have volatility. And we saw that post the GFC 2009, 10, 11, post taper tantrum 2013, 14. It leads to volatility, especially in emerging markets, and India will not be immune to that. We may be able to manage it better, but won't be immune to that. And the third divergence in fixed income is purely on returns. As global central banks and the Indian RBI, as they increase interest rate and liquidity, your returns on your short-term investments, liquid funds, overnight funds, money market funds, short-term fixed deposits, those will increase without having too much mark-to-market risk. Those returns will going up. Your savings account might not move. So if you have a lot of money in savings account, it is better to move the money into a liquid fund. The best way to play a rate hiking cycle tends to be in this short-term money market liquid fund kind of categories, where you keep accruing a slightly higher return as the RBI and the central bank keeps increasing interest rates. At the other end, because oil prices are at levels they are, commodity prices are high, inflation is still higher than where the RBI would want it to be, you would see volatility in the short term and medium term and the longer end of the bond market. So that's volatility. You might see a year of mixed returns in the credit categories also. Some segments are doing well because of economic recovery, but there will be some pockets of distress that will come about. Finally, on the rupee, we again see a year of volatility. Hawkish US Fed at a time when oil prices are relatively high, inflation is high. It should have a bearing on the investor sentiment, in the sense that because of that, current account deficit will widen, and that's demand for foreign capital to fund that current account deficit will be higher. We would caution that India is not in 2013, so we don't see a large depreciation like we saw in 2013, because Indians' forex reserves is much higher. The ability to attract capital is a lot more. So we are not in anywhere in that 2013 scenario, but this will be a volatile and a depreciating year for the Indian rupee. From a near-term political sentiment, a year where a lot of state elections are coming through, and especially very key state elections. And if the BJP say has a bad result or they lose in Uttar Pradesh, that will have an impact on investor sentiment. And it can also have an impact on the socio-political agenda that the government carries on, because we are just 2 years away from the 2024 re-election, national general election. So, that is something that we don't know how we're going to play out, but that's something that should bear on investors' mind. Our hope with regards to the pandemic is that, as we are seeing with Omicron and how the governments are dealing with it, we are finally learning to live with COVID, and hence we do not see too much cause for disruptions, and I think things will be better managed, better absorbed, and we'll go about in a relatively structured manner. So with that, wish you a very happy, a very healthy, and a successful 2022 to all of our listeners and investors. Thank you so much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.